Today I'll be showing you an extremely easy option strategy that you can do on a stock that you think will remain pretty stagnant over the next week or two. So for this example, I'll be showing you guys on Boeing. So let's see, let's look at the past day. So Boeing has remained around here. It's been dropping a little bit, and then now it's starting to rise. And let's say I heard some news about Boeing, and I think that Boeing is going to remain pretty stagnant over the next week or two. So we'll come over here, and we'll click Trade Boeing Options. So this strategy is called an iron butterfly. So the first thing that we're going to do is we're going to sell a call and a put at the same place that we think Boeing will be. So let's set our date to May 13th, which is 2 weeks out. And then where do we think Boeing is going to be on May 13th? So regarding the news that I may have heard, I think that Boeing is going to be at about the $157.50 price range. So we're going to sell a call at that spot, and then we're also going to sell a put at that same spot at the 157.50. So there we go, now we have both. Now you can see it creates this little pyramid. So this is the first portion of the iron butterfly, but now you can see that our max loss is unlimited. So if anything bad happens and Boeing tanks, or if anything good happens and Boeing goes extremely high, our max loss is unlimited. So we can, as long as Boeing keeps going, we'll keep losing more and more money. So what we're going to do is we're going to limit those ends, so that way we don't have to worry about that. So we're going to buy a put, let's say 1 gap, 2 gaps under. So you see 157.50, we go 1, 2, we bought a put there. So now you can see that this side's limited. So now we bought a put underneath, so now we're going to buy a call equidistant from the same middle point. So if you remember, we bought a put 2 spaces below the center point, so now we're going to buy a call 2 spaces above the center point. So I go here, we'll go 1, 2, and we'll buy one right there. So now you can see that our max loss is now capped off, and now it's only $84 max loss. So if Boeing is at 152.50, if it drops to 130, it's still the same amount of loss. It's just about $86. So this way, we don't have to worry about if Boeing tanks, we lose thousands of dollars, or if Boeing goes insanely high, we don't lose thousands of dollars. And then you can see right here, if Boeing ends up at the price that we guessed by May 13th, we'll get $413. So now we're going to come over here and we're going to visualize this a little bit better. We'll come over to Option Strat. We're going to click on Iron Butterfly. So we're going to enter our ticker symbol. It's already in here. So Boeing. Now all we do is copy this trade, this little thing that we made over here, into Option Strat. So this is your key right here. You'll just copy this over. So at 157.50, we sold a call and a put. So that's what we'll do first. So move this right here. This P is for put, so we'll move that to 157. Actually, it's only letting me do it by $5. Okay, that's fine. So we'll go back here, and we'll just switch this up a little bit. So let's say I think that it'll be at 155. This is just for the visualization purposes. So we're going to sell a call and a put at the 155. Then we're going to buy a put 2 under again, and we'll buy a call 2 above. So now you can see it's basically the same thing. Now we only leave $77 and max gain is 423. So it worked out to be an even better trade actually, but I just did that to show you the visualization purposes. So now we'll come back here. Now we're going to copy this setup. So sold a put 155, sold a call at 155, so that's already there. Then we bought a put at 150. There's the P for put at 150. And then the last piece is we bought the call at 160. So green call 160. So there we go. We'll place it like that. You can move around the implied volatility to see the difference of that, how that might affect your pricing, and then we'll reset that though. So we'll move the range down so we can see a little bit better. So between these gaps, you can see exactly where the prices will fall on what day. So we see Monday the 2nd. This is the range. If it's at 155, you'll be in $3 green. You'll come down here to May 16th, for example. If it's at 161.50, you'll be $13 in the green. And then as you get closer to your date, it's going to have to skew down and you're going to have to get closer and closer. But you can see if you happen to get it perfectly at $155, you'll get $437 on the 27th of Friday. Wait, we also have to change the dates. What did we choose? We chose May 13th. So May 13th. So here we go. This is better. It was on May 27th on accident. So here we go. This is exactly how it should look. So we get 423 on Friday the 13th. This is at the closing date, and then this is at the beginning of Friday the 13th if you're curious why these prices are different. But I like to use this website to visualize exactly what has to happen on what days and the pricing of it to see where the profits will be. Like I said, you can move around the implied volatility if more information comes out. Yeah, this is the iron butterfly strategy, and I hope this guys help you out. And if you have any questions, comment them down below. I'll be sure to answer them all. Thank you.